you'd have to dedicate all your time to studying the market, to getting to know the companies and all their competition. You'd have to diligence how they're growing. You have to understand the intentions of the leadership of those companies. You'd have to understand their stakeholder relationships and who's already invested in them and whether those terms are in your interests. So I'm going to take you through our asymmetric investment strategy. This enables us to target returns in the multiples each and every time we invest. And actually, the more times we invest this way, the more money we stand to make and the less we actually stand to lose as time goes by. And if that sounds too good to be true, then bear with me because I'm going to walk you through it starting right now. So this strategy is probably the one big difference between what we do and other strategies you'll find out there. And while the principles of this aren't new, how we deliver this in real time through our Insider program makes it unique. So let's dig in. Now, you'll hear the word asymmetric used quite often, but usually as a misnomer. It's often used to describe anything with enormous upside, and it's usually used when talking about tech and growth stocks and that sort of thing. Well, upside is literally half the equation. The other half is, of course, downside or risk, and keeping that risk relatively low. And this is where most people screw up. In other words, finding something that has the potential to return 10,000% is pretty easy, but determining the probability of that is not. Most investors, they'll assess risk by measuring all sorts of metrics, and you've probably seen all sorts of systems out there for valuing stocks and their risk-reward potential. But what they fail to take into account is the huge elephant in the room, which is that nothing is isolated from the effects of the world. There are so many unknown inputs that go into the price of something. And it's this complexity and randomness that models cannot allow for. That's the real risk when trying to work out the probability of a trade with big returns actually working out. So investing in anything that depends on a hell of a lot of things going right, many of them that you're not even aware of, is leaving a lot to chance, and it's just not sustainable if you want to grow your wealth through investing. But that's not the impression the average person gets, because every day we're told about the outliers. Those who are lucky and got rich usually go on to become celebrities, propelling the myth that it's possible for anyone to be just like them. Like the guys who got rich from investing in social media companies in the .com era. I won't name names, but you'll know them because they made a huge amount of money and now have podcasts or other channels about business and investing. Now, I'm not saying that they didn't see the opportunity or that they're not talented or whatever, but rather that for every Facebook, there were thousands of companies that failed. And at the time of actually investing, there were so many unknowns combined with a complete bubble in terms of how much capital was floating around in that space, that therefore what happened was mostly fortunate circumstances rather than shrewd investment minds at work. Now, to really illustrate this, let's cover some history. In the late 90s and early 2000s, if you were a Silicon Valley-based venture capital fund investing into the tech space, 1 in 4 of your investments ended up doing well over 10x returns. That meant on average, top venture capital firms were returning around 340% per year. Well, after a few years of posting these sorts of returns, more people started allocating money into this area, leading to a bubble which burst a couple of years later. And for the best part of the next 20 years, you had 1 in 20 bets making around 2x returns. I use this example to illustrate that normally it's not the individual companies and it's not the clever stock pickers that enabled these fortunes to be built. It's the bigger picture. It's the total amount of capital flowing into that one market, the tide that lifted all boats. If it was the clever stock pickers, then we actually wouldn't have had that massive bubble form and burst in that fashion. What you would have seen instead would be a more linear chart of decent returns and investors who could regularly and frequently return huge numbers, which is for the most part a myth. This is not unique to the tech bubble. It's repeated throughout history, and the same thing is happening right now, which you can track in real time. and that's the crypto market. And there's a chance that right now you could invest in a company that will be the equivalent of the next Facebook or Amazon. But if you want to invest in these companies intelligently, here's what you'd need to do to keep the risks down. You'd have to dedicate all your time to studying the market, to getting to know the companies and all their competition. You'd have to diligence how they're growing. You have to understand the intentions of the leadership of those companies. You'd have to understand their stakeholder relationships and who's already invested in them and whether those terms are in your interests. You'd have to understand the legal and regulatory environment on a country-to-country basis, which I will add is essentially impossible to do right now. You'd have to understand the time horizons of all this working out, quantifying the actual value when a company doesn't even make money at the point you're investing. You know, the list goes on and on. In fact, it's endless because it's new and therefore subject to ongoing change as it develops as an industry. In other words, even if you dedicated every waking moment to it, even if you built a team of 500 analysts working on it full time, you still wouldn't be able to call investing in any of these companies asymmetric because you couldn't quantify the risks to the same level you can in an established sector or industry that has a history of cycles and trends. Now, I'm not saying for a moment don't invest in crypto. What I'm saying is that while the returns could be huge, it's simply too high risk for it to be considered asymmetric. Instead, it's high risk and high reward, which is fine, but different. And by the way, this is not just true of crypto, it's the wider technology space, so-called growth stocks that everyone's investing in. So now that we've gone through why most so-called asymmetric investments aren't actually asymmetric, you'll want to watch the next video on how we achieve asymmetry with our capital, with our clients' capital, and how we teach insider members to do the same thing.